My dear students, today we are going to solve all important chapters of CBSE accountancy. Since the number of days are very limited for the examination, only 25 days or 30 days or more. So we will give you the important points, basic points in each and every chapters. If we go through the chapters, definitely we will be in a position to answer if any questions asked in every chapter. Let us take the first chapter, the partnership and basic concepts. What do you mean by the partnership? Partnership is nothing but two or more persons joining together to carry on a business, which is to be carried by all or any one of them acting for all. And then the profit sharing also according to the agreement. So there is an act, the Partnership Act 1932. According to 1932 Partnership Act, the relationship between persons who have agreed to share the profits of the business carried on by all or any one of them acting for all. This is a definition given by the Partnership Act. Please remember this. This is very useful up to accomplishment of CA courses. And then what are the essential features of the partnership? The essential features, there should be two or more persons. If there is one person, it is called proprietorship. And then agreement. According to the agreement, there must be an agreement. In partnership, the agreement is otherwise known as partnership deed. Let us talk about partnership deed deeply next. And then what is business? And then there should be a business motive. Without business, there will be no partnership. And then mutual agency. Mutual agency is nothing but the partner should act in such a manner, the one partner has to be as an agent of another partner. At the same time, he will act as a principal of another partner. For example, two partners are there, A, B. A is as well as, he is principal as well as the agent of the business, agent of other partners. B also, he is principal and agent of other partners. That is called mutual agency. And then sharing of profits. So, if not only the sharing of the profits, if the loss is occurred, that also will be shared by the partners. The liability of partnership. Liability of the partnership. If a partnership, that firm sustains loss, that loss is to be compensated by the property of the individual property of the other partners. So, here the liability is unlimited. As I already said, the partnership, there should be an agreement in partnership. The agreement, it may be oral or in writing. But the Partnership Act 1932 does not require that the agreement must be in writing. And then the document contains the term of agreement is called partnership deed. It is nothing but, the agreement is nothing but a partnership deed. It is containing the term of agreement. The object of the business, what are the contents of the partnership deed? It may be containing the objects for what purpose, what objects we have established. And then what is the contribution of the capital of all partners and what is the profit sharing ratio on interest on capital, on interest on loan, etc. And then whether the partnership can be altered. Definitely it can be altered with the consent of all partners. Please remember, Partnership Act, the partners deed can be altered with the consent of all partners. It should be prepared, the partnership deed should be prepared by the provision of Stamp Act. The Stamp Act, the previous period 1899, according to the Stamp Act, it should be prepared. And then it should be registered with the registrar of firms. What will be the contents of the partnership deed? The name and address of the firm, name and address of the partners, the capital contribution and accounting period of the firm, and then the date of commencement of business, the rules regarding the bank accounts, profit sharing ratio, interest on loan, interest on capital and interest on drawings, mode of auditor's appointment, rights, duties and liabilities of partners, settlement of accounts on dissolution of the firm and method of settlement of disputes, etc. Please remember some important provisions of partnership. Regarding as far as profit sharing ratio, if partnership deed is silent, the partners can share the profits equally. Please remember this important point. And then interest on capital. No partner is entitled to claim interest on capital. But it can be allowed when it is expressly agreed by the partners. But at the same time, one important point you have to bear in mind, interest on capital must be payable only out of profit. If there is a loss, if the partnership firm sustaining loss, so the interest will not be allowed. So interest payable out of profits and not if the firm incurs loss. Interest on drawings. Interest on drawings also, in absence of deed, no interest is to be charged. If any interest is to be charged, it must be mentioned and accepted and agreed by all partners in partnership deed. And then interest on loans and advances. If any partner advances any money to the company as a loan, he is entitled to claim 6% interest per annum. And then remuneration also, no partner is entitled to get salary unless there is a provision in partnership deed. There are two methods of partners capital account. One is fixed capital method, another is fluctuating capital method. Under the fixed capital method, there are two ledgers we have to prepare. One is capital account and then current account. In fluctuating capital account, only capital account in which all adjustments are to be made. Under fixed capital method, there are two accounts are to be maintained. The first one is capital account. The capital account in which the partner initially brought in some capital, that will be appearing always. There is no change in the capital account. So the by balance B body, this is a opening balance. And then if any amount, if any additional capital introduced by the partner, it will be in the credit side of the capital account by bank account debtor to capital account. And then if any amount withdrawn permanently from the partnership firm, that will be debited in the capital account. So if we balance the closing balance, we will derive it. And then apart from that, one current account is to be maintained. In the current account, there is debit opening balance or credit opening balance. At the same time, debit closing balance and credit closing balance. All adjustments are to be made in a current account only. For example, interest on capital. Normally we know the interest on capital, what is the entry? Interest on capital account to capital account. Instead of capital account, we are preparing the current account. So by interest on capital account to current account. So interest on capital is to be debited, and salary it is also expenses it is to be debited, and then commission also is to be debited. I mean in the credit side of the current account. And then profit and loss appropriation account. If there is any profit in P&L appropriation account, it will be in the credit side of the current account. And then reserves and surplus, if anything in the reserves, I mean in the balance sheet, are to be shared according to the partners profit sharing ratio. And then if there is any drawings, it will be in the debit side, and then interest on drawings are also coming in the debit side of the current account. And then according to the P&L account, profit and loss appropriation account, if any loss is to be in the debit side of the current account. If you balance, you can get either debit or credit closing balance of the current account of the partners. Under fluctuating capital method, only one account is to be maintained, that is capital account, in which all adjustments are to be made. This is the opening balance. Apart from that, if any fresh capital introduced by the partner, it will be in the credit side of the capital account. And then any reserves in the balance sheet is to be contributed according to the ratio. And then salaries, if salary is given, interest on capital is given, it is to be in the credit side of the capital account. And then if commission also, it is also to be in the credit side of the partner's capital account. If any profit, as per the profit and loss appropriation account, it will be in the credit side of the capital account. If there is any drawings, it should be debited. Interest on drawings also is to be debited. And then if there is any loss, as per the profit and loss appropriation account, it will be in the debit side of the partner's capital account. If we balance, that is the closing balance, to balance C body. Let us solve one important problem in your book back numerical questions. Let me read the question first. Tripathi and Chauhan are partners in the firm sharing profits and losses in the ratio of 3:2. Their capitals were rupees 60,000 and 40,000 as on 1st January 2015. During the year, they earned a profit of rupees 30,000. So the profit is to be shared according to the profit sharing ratio. According to the partnership deed, both partners are entitled to rupees 1,000 per month as salary. So salary is to be given to both partners. The monthly salary rupees 1,000 each. So 12,000 rupees will be calculated for whole year, 12,000 rupees. And then 5% interest on their capital. On the opening capital, how much? The 60,000 and 40,000. We have to calculate 5% on interest. So it will be also in the credit side of the capital account. And then they are also to be charged an interest of 5% on total drawings. So interest on drawings is 5%. What is the drawing amount? Irrespective of the period, which is rupees 12,000 for Tirupati and 8,000 for Chauhan. So Tirupati has drawn rupees 12,000 and then Chauhan drawn rupees 8,000 rupees. For that we have to calculate interest on drawings. Prepare partners capital accounts under fixed capital method. Capitals are fixed. So under fixed capital method, there are two accounts to be maintained. One is fixed capital, capital account, and then current account. Let us solve in the board. Under fixed capital method, there are two accounts are to be maintained. The first one, capital account. Let us prepare the first capital account. The opening balance of Tirupati and Chauhan are 60,000 and 40,000 respectively. So we can write it down like that, by balance brought down 60,000, 40,000. So there will be no change. It is always fixed. So that is fixed capital method. So if we balance, the same amount will be coming in the debit side, and then we have got to carry forward to the next period. Understand? Now we will draw partners current account. The profit, actually 30,000 rupees profit, it has to be shared among Tirupati and Chauhan in the ratio 3:2. So for Tirupati 18,000 rupees and Chauhan 12,000 rupees. And then salary, every month we are paying 1,000 rupees. So the total salary of a month, year, 12,000 rupees, 12,000 rupees. It has to be multiplied by 12. And then interest on capital, the previous capital, the opening capital of Tirupati and Chauhan are 60,000 and 40,000 respectively. We have to charge 5%. So 3,000 for Tirupati, whereas 2,000 for Chauhan. And then total drawings of Tirupati 12,000 rupees and Chauhan 8,000 rupees. So two drawings in the debit side we have to write. And then interest on drawings also 5% on 12,000 and 8,000 respectively. So it will come around 600 rupees and 400 rupees respectively. If we balance, the closing balance as per partners capital account will be 20,400 rupees for Tirupati and 17,600 for Chauhan. So it has to be carried forward to the next period, by balance brought down 20,400 for Tirupati and 17,600 for Chauhan.